Thank you and good afternoon, everyone. We welcome you to Finbud Financial Services H1FY26 earnings call. We have with us on the call today Parth Pandey, whole-time director, Vivek Bhatia, whole-time director, and Parag Agarwal, who's the whole-time director and CFO. I must remind you that the discussion on today's call may include certain forward-looking statements and must be viewed in conjunction with the risks that the company may face. I now request Mr. Parag Agarwal to take us to the company's business and financial highlights, subsequent to which we will open the floor for Q&A. You can raise your hands to join the queue and unmute to ask your questions directly to the management. Thank you, and over to you, sir.
Thanks, Rashid. Good afternoon, everyone, and welcome to our first earnings call as a listed company. Since this is our maiden call, we'll take some time to quickly run you through our background, our company's background, our business model. Then we would touch upon our H1 financial performance and some flavor around how we see future business prospects for us. So quickly on the company background. So we are a retail loan aggregation platform helping customers get personal loan, business loan, and home loan through various lenders with whom we are empaneled. So when Finbud was started in 2012, there were 3 key observations, challenges that we saw in the market at that time. One was that the borrowers wanted choice. They didn't want to be restricted to their own savings account bank or the salary account bank. That was one. Second was at that time, and even today, the market continues to be dominated by the agent network. So these agents primarily had 2 requirements. One was to get access to all lenders and all retail products at one platform. And second was to have a faster working capital cycle. The third challenge at that time that we saw was the banks. Actually, that was an opportunity for us, an observation for us, that the banks were looking to aggressively scale up third-party distribution channels. It gives them a variable acquisition funnel along with a high-quality customer base. So it was to address these challenges and observations that Finbud was started in 2012. In doing so, over the years, we have now built a vast agent network of 2,500 plus master agents, which gives us a last mile connectivity of close to 60,000 plus last mile agents on a pan-India basis. Today, we have the capability to service customers across 30 plus states and union territories, across 19,000 pin codes. On top of that, we have built very extensive technology-led API integrations on our digital funnel. And we have built a solid data lake of close to 4.5 crore customers. Now, what differentiates us in this market is our ability to stitch this entire ecosystem together. So and that has a compounding effect, on every application henceforth. So the cycle starts with the agent network. The agent gets us high intent, well-screened applications onto the platform. Even though the acquisition costs for this channel are higher, but that's the bedrock, that's the foundation for our entire data lake. So in the start of the cycle, we have the agent network, which feeds our data lake. Now, on top of this data lake sits our entire borrower behavior layer, which comprises of our data analytics team, our technology team, and our marketing team. What this layer does is that it helps us build our digital funnel, which has a far more predictability outcome, which has a far more intelligence-led outcome, rather than just an assumption-led or a blind, application with various banks and hope for success. So this is the data lake which feeds into our digital platform and as well as our cross-sell platform. Once the customer has come and we have the behavioral analysis onto the customer, that is how our digital business grows. And along with that grows our entire cross-sell funnel. So that's in a nutshell what our overall business model looks like. Now coming to our half-yearly performance. So we closed H126 with a top line of 139 crores. That came at an EBITDA of around 6.5%, which is around 9 crores of EBITDA, and a PAT of 3.7 crores, which gave us a 5.1 crore profit after tax. We saw healthy growth along all these three fronts, growing at the range of 36 to 38% on all fronts. On an operational basis, we closed our first half on a disbursal of around 4,300 odd crores. We were able to add 350 odd master agents onto our existing agent network, which led our agent network closer to 3,000 mark. And we continue to have very healthy agent versus digital mix, which is currently at agent-led businesses at 86% and around 14 odd percent from the digital side. Now, on the some of the strategic initiatives, key strategic initiatives that we would like to highlight, which happened in the first half. Number one, we were able to successfully start and expand our gold loan offerings. We started that initiative around 7-8 months back, and today we are touching close to 50 odd crores of monthly disbursals of gold loan. Our primary partners on that are Muthoot and DBS. Second was we have successfully scaled our wellness product. In the wellness product, we offer a prepaid wallet offering to our customers in partnership with a health tech platform called Alive. In this, basically, the customer can use this prepaid wallet to meet his out-of-pocket medical expenses like doctor consultation, pharmacy, and diagnostic costs. On the wellness front, we were able to scale that up to 50 lakhs of premium per month with very, very high attachment rates on our digital business. And obviously, thanks to all our shareholders who showed trust and faith in the company, we were able to close our IPO of 71 crores, gross IPO proceedings of 71 crores with a healthy subscription of 4+ times. So that's on our first half performance. We expect that we will be able to continue this growth momentum that we have seen in the first half, in the second half also. We are confident of closing the current financial year with a growth of almost 35% versus the last year, which would entail that we will be touching close to 9,700 odd crores of disbursals across all products put together. We are confident that we will be able to continue to have the same product, the same channel mix between agent and digital. And we are also quite hopeful that the margin profile will continue to hold, if not grow from here in the current financial year itself. That's on our current year's estimate that we see. On a long-term vision, we see that we have the possibility and we will be working towards becoming one of the leading financial aggregator, which is backed by a multi-channel approach, which has got both digital and offline, which has got rich behavioral and borrower-led intelligence platform, rather than, as I said, just an assumption-led platform. And we would be in a position to create a super agent app and ecosystem, which is able to tie all of this and help us monetize our data that we have built over the last 10+ years, which currently is at a 4.5 crore plus customers, with very, very deep insights onto these customers, such that our ability to cross-sell, our ability to have stickiness with the customer continues to increase. Having said that, I would now leave the floor open to further questions that any of the participants might have.
Feel free to directly unmute yourself and ask your questions.
Hi, this is Rohan. Shall I go ahead?
Yes, yes,
So,
Rohan, please.
yeah, hi. So this is Rohan from Equirus. Uh, good evening. So, just want to understand the two channels that we have of lead generation, network channel as well as online channel. If you could just help us run through the unit economics, what kind of sharing do you do to the network in a network channel, and how is it different from the online channel?
Sure. So on the agent channel, Rohan, that's our primary customer acquisition channel. That is the channel on which the entire data lake of ours is built. Considering that, this also comes with a very high intent customer, pre-screened applications, and so on and so forth. Over here, the acquisition costs are very high. Typically, in the agent channel, out of say 100 rupee revenue that we would be making, close to 90% of that goes back to the agent, and 5% is our processing, our platform, and our manpower cost over there. But the way we look at this channel is not as a margin story. The channel business, the agent business gives us a very high predictability outcome in terms of our top line. That is one. Second is we look at it as a customer acquisition mode. So if you were to compare this customer acquisition cost with say some of the online players who tend to spend almost 2 times of their first time revenue on just the customer acquisition cost. Over here, we have spent like say 95% of the revenue, and it has also given us say a 5% of gross margin. So any online player, any digital player would have probably spent millions and millions of dollars to acquire this kind of a customer base with intent, with pre-screening, and three, four very, very important cohorts of information. One is we have the demographic profile of the customer. We have the income profile of the customer. We also have the employment profile. And finally, we have his past bureau performance. So considering all of this, so our customer acquisition or rather our margins on the agent business has to be looked at considering these values, also value addition that has come along with the agent profile. So that's on our agent business, which is say a 5% gross margin. Now, as I said, on top of this data lake sits our data analytics, technology, and the marketing funnel and the marketing layers. Over here, our approach is the other way around, that I am able to have an insight into customers' behavior, his profile, and I do a very, very targeted marketing only on customers who I think will be able to get a loan eventually. So where compared to the fact that on our agent business, our approval ratios are say roughly around 40 odd percent. On our digital channel, because I have these pieces of information on which I am building further intelligence, our approval rates tend to be close to 80%. Because of that, the margin profile of the and obviously I'm able to cross sell also over there. So all of that put together, our digital business is currently at a roughly at a 15% margin profile business. So 15% versus 5%, but this 5% is a customer acquisition which has come to me as a customer acquisition plus some 5% margin also.
So digital usage was 1550 or 5050?
1.5.
Okay. But so just trying to understand, when the agent is not there in a digital channel, 90% cost which is incurred in sourcing from the agent is not there. So why such a low margins on the online channel?
So I think, let me take that question, Rohan. So see, when we are talking about remarketing, right, there are three components of cost which are involved, right? One is the cost of remarketing to the consumer, because we need to understand that of all the borrowers who are on the platform, it's not that every customer is looking at borrowing at all points of time, right? So we have to build a lot of propensities in the back end to understand who are the potential customers that we can target to. So A, there's a cost of acquisition or incremental retargeting cost to these consumers, which is the digital marketing cost, which is out of the 100 rupees of revenue generated on the digital channel, roughly around 25 odd rupees is the digital marketing cost, which is the incremental whatever intent generation cost, right? Then there is obviously a operations cost here because a lot of customers come into the funnel. But there are a bunch of these customers who are looking for some kind of customer support, some kind of an operating layer, etc. Plus, there's obviously a large team supporting these customers from technology, analytics, and a digital marketing standpoint, which is essentially the manpower cost which is required to build this entire platform and run it successfully, right? That cost is around 30% of the total revenue that is getting generated. So 55% roughly is the cost of the manpower required to run the digital channel, which includes the technology manpower, the analytics teams, the marketing teams, the sales support teams, etc. And 25 rupees would be the cost of customer generation. Incremental to that, there are obviously certain overhead costs, which are largely your technology platform costs, the cost of AWS for hosting data, the cost of multiple third-party integrations that we have, the cost of accessing bureau data, the cost of bunch of third-party tools that we integrate to ensure that the customers are able to see the conversion rates that we are talking about. I think the way to look at this entire piece is the digital business provides us a possibility of operating leverage, which is on a network kind of a business absent, right? So essentially, if I was to hypothetically grow the digital channel multifolds, my operating cost does not go up in the same proportion because the same set of people that I was talking about on the technology side or the data side or the marketing side have the ability to support a significantly larger growth on the digital side. So your operating leverage kicks in. And hence, I think over a period of time, the margin on the digital business would significantly increase or expand from here. But I think we have to also be cognizant of the fact that there are multiple, sort of elements to this entire thing. And we are obviously, since this is largely a data and a marketing play, there's significant amount of investments that need to be made to ensure that the data is enriched, updated, and the technology stack is always sort of, agile and has the ability of being able to work with multiple lenders. So today we have over 15 plus API integrations on the platform with lenders where we have the entire sort of ecosystem being built out on that platform. So essentially, as the number of lenders on the platform and the sales opportunities keep increasing, you would see the margin profile on the digital business keeps increasing.
Sure. And so with respect to the agent channel, what advantage do they get in working with you versus directly working with the lenders?
So, okay. So working with the lenders, point which is there. So I'll just give you a brief profile of our lenders. So our biggest, a profile of our agents. So the biggest agent that is there with us currently does probably say a monthly business of 20-25 crores. With the average volume of all our agents, it will be, say 3 to 4 crores, maybe 5 odd crores will be the average business volume of these agents. Now, for them to work directly with the lender, so typically in our business, the commissions that we get from our lenders are all volume linked. So the more the business that you do with a particular lender, the higher is the payouts. And after a particular point in time, it caps out. So just some anecdotal numbers. For HDFC Bank, the commissions cap out at 40 crores per month. Now, for the largest channel which is there with us, agent which is there with us, who does 20 crores, if he were to do business directly with a lender, he will not be able to get the best commercials out of that lender. So he does business through an aggregator like us so that his commercials, his revenues can be far higher versus if he were to do it directly with a bank.
Sure.
So if, for example, typically in some of the traditional banks, say they pay us 3%. If the agent was to do his 15 or and 20 crore is his total business. So his single largest bank will probably not even be 10 odd crores. So if he were to do business directly with a bank, he will be getting probably half of that payout. Whereas, as I said, we are sharing 90% of our revenue with that agent. So there's a huge commercial upside that he sees in working with a player like us.
Sure. Just the point that you said that a bank caps out a commission to an agent on a monthly basis. So for us, as we scale, will that be a limitation? Like, how are you going to address that?
So see, we have today close to 100 plus lenders. Okay, and there are multiple products which are there with them. So there's a personal loan, business loan. Within personal loan, they have a personal loan standard and a personal loan digital. Players like Bajaj, they have a different slab for metro cities and a different slab for non-metro cities. So for the larger players, we have kind of capped out our commission percentages. We have capped out, to answer your question. But since we keep on adding newer and newer lenders, there is always some lender, some product where for a player like us also, we have not been able to hit the highest slab. So there is a potential to increase our revenues from those players. But for the large players, the HDFCs and the ICICIs of the bank, our percentage commissions have peaked out.
Yeah. I have more questions. I'll get back in queue. Thanks.
Chirag, you can go ahead and ask your question.
Sure. Sir, I wanted to understand more on the data monetization and your plans in the future. So, if you're capturing so much data and customers, will you eventually become an NBFC and underwrite loans? What is the thought process on that?
Yeah, so I think Chirag, I think the entire game is largely around being able to build the data monetization layer, because that's where the real sort of the effect of whatever we have done really comes through, right? And also from an operating leverage perspective, that's where really the operating leverage starts kicking in, right? So I think I would want to sort of answer this question in a way to kind of explain what is it that we are thinking about this and how are we thinking this evolve with time, right? So one is obviously, which is around increasing the products on the digital platform, right? So because there are certain products like unsecured loans where we have sort of poured into in the digital side, but there are a whole host of products that these consumers are consuming, which could be done digitally. And I think a case in point, I think what we made in our opening remarks, things like gold loans, for example, or we have created a health and wellness product which gets embedded with our loans, etc. So, and I think in the coming quarters, or we will also see other products getting added to that kitty. So we can expand horizontally, which is being able to offer more products to the same consumers on the platform, which again helps us increase the lifetime value of the customer. Into our data bank, we have then the ability of creating a bunch of product opportunities for the customer. And as the customer keeps consuming these products, our lifetime value for the customer keeps going up. So that's, I think, the first part of the question, first part of the answer, rather, right? The second piece is really in our ability to also expand our conversion funnels. And I think that's where a part of the NBFC story sort of comes through. And I think we had mentioned, in our, and it's part of our objects also, that we have a strategic NBFC within the group, where we would be sort of seeding that out of the proceeds of the IPO. And obviously the NBFC is also looking at raising external capital along with the proceeds that we would be sort of seeding. But the idea there is that it helps us with funnel expansion, because there are today, and I think the point being that if we have close to 9,700 crores of disbursals that we're doing on the platform, the incoming funnel is multitudes of that, right? And the ability to then expand that funnel by being able to create interesting product opportunities, being able to plug leakages that we may have with lending ecosystem or lending partners, the ability to sort of have a ability to kind of create opportunities of customers that today are dropping out because of inefficiencies that could lie within our ecosystem or the lender's ecosystem, that can get plugged via our NBFC layer. So the NBFC here is more a strategic value unlocking opportunity for us, which helps us unlock value. So I think from a data monetization perspective, I think there are two elements to this. One is obviously what we can do by creating new products on the platform. And right now, I think we're sort of discussing credit products, but over a period of time, there's an ability to foray into non-credit opportunities also. And I think we've been able to validate that through our health and wellness offering, which is essentially an OPD kind of a product that we are able to offer. And I think we are in the process of figuring out what are the other product categories that we could potentially enter in the coming years, right? So one is obviously in terms of horizontal expansion, both in credit and non-credit. And then in terms of being able to optimize the funnel via the NBFC sort of. So I think those are the two ways in which you would see the sort of the data monetization play out. And honestly speaking, that's the flywheel that we're looking at sort of optimizing, because as to just understand the business better, as the agent ecosystem keeps growing, the data lakes keeps increasing. And once the data lake keeps increasing, the digital opportunities keep increasing. And when we plug that with more products and better conversion, then the conversion rates and the funnel keeps improving and the margins keep improving. So I think it's a question of us being able to build this flywheel and rotate this flywheel at a very fast pace that will ensure that we continue to grow with very, very robust sort of revenue growth as well as having an expanding margin profile.
Got it. So, follow on to this is that currently have you do you have any book underwritten in your NBFC? That's the first part. And the second part is there any regulatory hurdle that you have to face in terms of cross-selling the data that you capture?
So we already have a licensed RBI licensed NBFC. So from a regulatory perspective, it's been there with us in the group for now over 6 years. So it's not something which is new.
Okay.
And we've not, so from a regulatory standpoint, I think we've completely clear. In terms of the NBFC, at this point of time, the NBFC have obviously, we've built this company very frugally. And to be very honest, before the IPO, it's not that we have put a lot of capital in the NBFC. Today, the capital in the NBFC is just enough from a perspective of meeting regulatory guidelines, right?
Understood.
But I think, but going forward, the plan is obviously to capitalize the NBFC.
So currently there is nothing underwritten in the NBFC. That assumption is correct, right?
That's right. That's right. You're absolutely right.
Okay. And there is no regulatory hurdle to cross-sell the data or anything like that?
No.
Right. Okay. Thank you. Thank you so much.
We can take the next question from Rahul Bangadia. Rahul, would you like to unmute yourself and ask?
Thank you very much for giving me the chance. Congratulations, team, on a great set of numbers. Since we were discussing NBFC in the previous questions, just if you could give us a status on the fundraise side, what has been the state? What is the status there?
So currently, this is something that we are still working on, Rahul. Nothing that we can share away currently officially.
Okay.
Once we have some insight into the fundraising over there, we will definitely come back to you. In fact, moreover, before we do something formally over there, we would be coming back, to the board for approval also. So as of now, the efforts are on. As we said, that we have just started the hiring the team over there in May, June actually. So as of now, some of the discussions that were there that were primarily around, first let's have the IPO out of our way, and then we will have those talks.
Okay. Second question would be, given your disbursals about 4,250 crores in the first half, the turnover reflects an average yield of about 3.3%. That's a slight uptick from what you did in FY25. Where do you see this, and how do you see this in the sense, does this go up? Does it remain steady here, depending upon what composition you do? So just give us a sense here, please.
So this will see a slight uptick year on year as our digital mix increases. So over here for this average of 3.3, rough numbers which are there is that on the digital front, our average revenues, our average commissions are at say 3.7, 3.8% versus say 3.1, 3.2 for the agent-led business. As our digital mix increases, this number will also continue to go up gradually. Also, as we said in our first question, that some of the fringe players with whom we have started business, with whom we have not yet scaled our volumes to the max level, that would also result in some fillip in our agent-led or in the traditional lender-led commission rates. So this 3.3 will possibly keep on increasing by 5 to 10 paisa every year.
Okay. So you see that runway for the next, let's say, what, 2-3 years, 0.3 going to 3.4, 3.5 type of
Yes.
number.
Yes, at least for the next 2 to 3 years, that should be there. As I said,
Right.
as we keep increasing our digital mix, that will automatically keep going up.
Right. In the PPT, you've given that the PL, the personal loan side disbursements in the banking system last year about 9 lakh crores, mota moti 8.8 trillion or something like that. 9 lakh crore number. What is the rate of growth now? It was a 20% CAGR before, but what is the rate of growth now in that disbursement TAM of yours?
That would obviously, because of certain RBI, restrictions which were imposed on some of the digital players to stop, for example, the small ticket size loans. Certain tightening or the unofficial messages to slow down on the growth of the PL, that has had an impact on the overall growth rates of the industry. We believe that it would still be in the range of 13 to 15% for the overall industry put together. That's what we hear from our lending partners. But as I said, for us, we are just a tiny player in that overall market as of now, and hence the canvas available to us to grow is quite large.
Yeah, sure. Even if it is a $10 trillion number this year, you are talking about less than 1% market share there. So
Less than
yeah,
1%.
so that's
Exactly.
yeah,
Yeah.
fine. Yeah, and a question on the balance sheet. There is a loans and advances number and the balance sheet number. If you could just give us, explain to us the nature of that loans and advances number. It's a big number in the balance sheet.
So these are typically the advances and that we would have given to our agents to help them grow their business. So as we had initially said, the profile of our agents are on an average, they are doing, say, whatever, 5-6 crores of business. So they do not have access to any formal capital if they wanted to grow their business. We have historically seen through our capital support, agents who had a 20-30 member team have grown to a 200-member team, and they have continued to be with us. For example, our Chennai partner has been there with us for the last 10 plus years. When he started off, it was a 20-member team, and today almost a 200-odd member team. So all this growth requires, they require capital for that, and they do not have access to any external capital. So that is one of the key value add or one of the key supports that they look at a player like us to help them grow their businesses. So that is predominantly our loans and advances that we give to our agents to grow their business.
Right. Thank you very much for answering those questions. Thank you very much.
Thanks, Rahul.
Right. So Pranav had put some questions in the chat. His first question was, how resilient is Finbud's growth model to potential RBI tightening on unsecured personal loans? So I'll just go through all the questions. So his second question was, what market share gains can Finbud realistically capture in tier 2 and 3 cities versus established players like MyMudra or Andromeda? And the third question was kind of covered already by the management. But his question was, how might a 70 to 30% agent to digital shift impact the margins overall if the digital customer retention lags?
Yeah, I think to answer your first question, see, this is a highly regulated industry. So I think, and we go through regulatory changes pretty much all the time. I think in the last 12 months, I think there have been a bunch of regulatory changes that have happened on the unsecured lending side. Well, the first being, I think last November, the risk weights on personal loans went up, right? From 100%, the risk weights went to 125%. Secondly, I think there was a sort of a message that went out from the RBI to cap interest rates. I think they had also barred lending for a few NBFCs that were charging or overcharging interest rates. So I think that went through. The third impact was obviously that there was a curb on the small ticket loan. The RBI kind of unofficially gave a direction that less than 50,000 rupee loans the space of that should be slowed down. So this is a business that goes through regulatory changes pretty much all the time. And I think even in the light of the regulatory changes that we faced over the last 12 months, I think we've been able to grow at 35%. And I think the point that Parag was kind of making, that we are today only 1% or sub 1% of the market. Essentially, it's a very, very large opportunity that is available, right? So I think from that perspective, I think we have to be cognizant of the RBI sort of changes, but it doesn't take away from the size of the market and the fact that credit growth in India will continue to sort of grow, because I think that's the nature of how consumption is moving, right? Consumption is largely being driven by credit, and hence I think there would be this continued sort of growth, right? So I think that is one important thing to talk about. Also, I think from a regulatory standpoint, we continue to ensure that uh, we are sort of in cognizance of any regulatory changes that happen. But I think the size of the market and just the credit behavior of consumers make us confident of the fact that we are fairly resilient to any kind of changes that come our way. I think the second.
Also, I'll just add one more point to what Parth was saying. We have mentioned that also in our presentation. You would see that our top five, so we have a fairly diversified lender pool. Our top five customers account for roughly around 50 odd %. And after that, it's a very long tail. And the top five customers who are there, our top five lenders, they are the largest banks and NBFCs in the country. So it comprises of HDFC, ICICI, Bajaj. So we have a fairly stable lender profile on whom we have grown. It is not the new age fintechs on whom we have piggybacked and grown our business till now. So that automatically, to some extent, insulates us from minor regulatory changes, barring any shock which might be there. That's a separate issue. But some of these regulatory changes which are there are something that our long-standing large lenders are able to withstand, and hence it does not have a very serious impact on us.
Yeah. I think Rashi, I think the second question, if you can just repeat that. So I think the first question was around the regulatory changes.
Yes.
What was the second question?
So the second question was about so what market share gains can Finbud realistically capture in tier 2 and tier 3 cities versus established players like Mahimundra and Andromeda?
I think that's where the digital model becomes interesting, right? Because I think it is not dependent on geographical presence. I think the biggest challenge that pure offline players face is essentially the hurdle of starting a new geography, hiring people, training people, onboarding partners in a particular market. Today, our digital model allows us to operate across the country. Today, as we speak, we have the ability to service over 19,000 pin codes. So that is roughly, I think India at this point of time, I think has 22,000 plus pin codes. So we are already sort of having the ability to kind of do that across 90,000 pin codes. And I think what we are seeing is a large part of our digital business is actually growing out of the presence in the tier 2, tier 3, tier 4 cities. Because I think that's where there is a large unmet demand of credit. And those customers, because there is not so much of physical infrastructure available or not many lenders who may have physical sort of presence available, but the digital model allows us to service these customers, right? So a lot of the fintech partnerships that we have, or a lot of the NBFCs which are more digital in nature, today we have the ability to service customers in remote areas. And I think that's where the differentiation with pure play traditional offline distributors also come into the picture, because they are kind of limited by the ability to kind of have a service in a particular physical presence, which today our digital model is able to leapfrog, and we don't have that dependency. And I think that's where the ability to service tier 2, tier 3, tier 4 markets come into the picture.
Right. And his third question was how might a 30% agent to digital model, like the shift from 70 to 30%, will impact the overall margins if digital customer retention lags?
I think Parag already mentioned the margin profile between the digital and the agent business, right? And I think I also kind of spoke about our ability to increase monetization by having more products on the platform, which ultimately will lead to improving digital margins. And I think the point about the super app that we spoke about would also help us in increasing the agent margin. So I think going forward, I think the change in mix would have a significantly large impact on the margins, because once you see that mix changing from currently around 85-15 or 86-14 that we are at to 70-30, the incremental digital contribution is coming at a far better margin profile. That's one. Secondly, I think all the new products that we're looking at adding on the platform obviously increases the overall margin on the digital business as well. And thirdly, I think the ability to kind of create this super app kind of an ecosystem for the agents, where we are not only providing them access to lenders, but a variety of other solutions that we are looking at building for the agent, will help us increase the margin on the agent ecosystem as well. So I think the combination of all these three parameters coming along would only ensure that with this mix being sort of achieved, the margin profile looks significantly different than where we are at right now.
Thank you. Ishan, would you like to unmute yourself and ask your question?
Thank you, sir. Congratulations on this. My question was your FY30 guidance of 1,000 crore revenue and 10% margin. Does that include your NBFC business as well? So have you forecasted for it, or is that add-on to this number?
Yeah, so the NBFC will be an add-on. I think what we are projecting on the sort of standalone 2030 are standalone financials for the distribution business.
Okay. And when do we expect this NBFC to ballpark be operational and start contributing to the business?
So I think we are already sort of we have undertaken the process. I think it'll take us maybe maybe between 3 to 6 months, I would assume, for us to get everything operationalized. It's also that we would have to sort of seek certain regulatory and board approvals, etc. So we're in the process of doing all of that. So I think a realistic timeline, I think, would be between 3 to 6 months from now.
Thank you.
Right. So the next question we have in the chat is from Omkar. So he's saying whether NBFC will remain subsidiary of Finbud till the next 3-4 years.
So, Omkar, that would depend to a large extent what is the fundraising plan and how much of that they are able to execute. As you would all appreciate that NBFC is a capital intensive business, and what is the book that we are able to build over there? On top of that, what is the market acceptance of that? How much capital we are able to raise over there? That is what will eventually result in whether it continues to be a subsidiary or we become a significant minority shareholder over there.
Right. Thank you, sir. His next question is, the presentation has provided guidance only on loan aggregation business. So please provide certain guidance for the NBFC too. And his next question is, as per his understanding, NBFC profitability can be much higher than loan aggregation business.
So as I just said that, we currently do not have a visibility as to on a long-term basis, whether that NBFC would continue to be our subsidiary or whether we will be at less than majority over there. Hence, in our presentation, we have talked about only the parent company's standalone business performance. And as Parth said, currently we are in a process of just setting up the operation. So we are in the process of hiring the team. As of now, we do not have any capital over there to lend itself. So we are just setting up the team, building the product, building the technology platform, doing integrations. So it's a very, very early stage as of now to give any projections for the NBFC, because it could also be dependent on the capital available over there. So once we have a little bit more clarity in it in the next 3 to 6 months, we will share some color around that also.
Right. Thank you, sir. Pushkar, you can unmute yourself and ask your question.
Yeah, hi sir. I thought we had raised some funds in the IPO also for the NBFC, right? So is it just for
Yes.
team building and that for now, or what are the funds, ultimate use of those funds?
So as Parth said that we will eventually be, not eventually, we are already trying to raise funds in the NBFC. And as part of that fundraising effort, the 15 odd crores that has been marked in our RHP is earmarked towards the LTCV, towards our subsidiary. So that's part of the overall fundraising that the NBFC will be doing.
So
So it
this
is not,
15
it is not
crore,
for team building.
Right. So this 15 crores will also be invested at the valuation at which other investors would come in,
Yes.
and we can get a realistic update on that in 3 to 6 months.
That's right.
So this money is currently earmarked. I think this
Okay.
will
Thank you
become.
so much.
Thank you.
Right. So the next question in the chat is from Bongoni. So they're saying that congratulations on great results. So his question is, where do we see the company down the line in the next 3 to 5 years in terms of market share and revenue guidance?
Yeah, I think we've kind of touched upon that in our narrative as well as in the presentation that we've given out. I think we are very confident that we can continue to compound over the next 3 to 5 years at the current CAGR growth rates, if not better than that, right? So I think is the first sort of large level point that I would want to make. Right? Also, I think the fact that because we are operating in a fairly large market and a fairly evolved industry, right, which continues to grow. I think from that perspective, being able to sort of hit the projections that we have spoken about, and I think we've also been able to demonstrate that now that over the sort of the existence of the company and even in the first half of the year's results. And I think we have also kind of mentioned that even in the second half of the year, this year, we continue to hope to have the same kind of sort of growth rates, right? So I think from a compounding perspective, I think we are confident that over the next 3 to 5 years, we would continue to grow at the rates that we have mentioned. I think in our presentation that we have put out, there is a sort of a long-term FY30 number that we have mentioned as well, and which kind of is an outcome of being able to compound at the growth rates that we are currently operating at.
Right. So that swiftly takes us to the next question. So from Venkata. So is asking that you mentioned 1,000 crore revenue by 2030 in the investor presentation. So and he's asking whether this is doable, and he's asking, could you also explain on the market size and growth and the possibility to achieve this, and what are the major risks that are involved?
So I think, he's mentioned a number that's already there, and I think I've given the logic as well, which is compounding at the CAGR, to sort of hit that number. I think we're very confident of being able to get there. I think we have demonstrated, that growth rate consistently, and I think we are confident given the way that the business model is built out and the execution capability that we have within the team, we would be able to hit those numbers, that we projected. So I think the confidence is fairly high. In terms of opportunity, obviously, the credit markets are very, very large, right? So just to give you a case in point, the monthly disbursal on unsecured loans is 1 lakh crores, right? That's just the monthly disbursal numbers that are there, right? And in terms of book size, if I was to talk about, right, the overall credit industry in terms of just unsecured loans is upwards of 15 lakh crores. I think that number on secured loans is even larger. So the market is very large, and we currently have a less than 1% market share. So I think from just having a sort of a very minor market share itself, there's a possibility of creating a very large company. And as the market share keeps increasing and as we keep penetrating into new products and sort of new opportunities, the ability to continuously grow at the growth rates that we have spoken about and hit the large sort of outcomes that we are looking at chasing, I think becomes a realistic possibility. I think in terms of challenges that I think he spoke about, I think, there are obviously macro level challenges that, because I think in terms of credit markets, the macro challenges, sort of impact lending industries very closely, right? Because typically the slowdown in credit largely happens when there is some amount of macro changes that sort of come in, right? And also the other challenges are more regulatory in nature, which I also kind of touched upon in my earlier narrative. So these would be the large two sort of challenges to watch out for. But in terms of just the sheer size of the market or the business model that we have built or the multiple lenders that we have on the platform, or the kind of customer base that we have created and the incremental opportunities that we can sort of unlock using that, I think the opportunities are manifold.
Thank you. So his next couple of questions are, so what are the scale of economics can we achieve with PAT margins 10% or above? And he's also asking, so any other products we are planning, like the UPI tech platform, mutual fund distribution, health insurance,
Yeah.
perhaps?
So I think I think foraying into other financial services product would be the most natural extension for us to kind of look at, right? But I think I think the first step of really product expansion would be within the credit ecosystem, because today there are a bunch of other credit products which we do not cater to. And I think we've started sort of creating some of those opportunities via the data engine that we have created. I think that the narrative around gold loan that Parag was talking about was one of the initiatives that we undertook. And I think we've seen very high, very quick and very early success out of that. And I think now we are in the process of now sort of growing that franchise, adding more lenders, etc., to make that a significant contributor to business. I think we've also seen success in the health and wellness product that we have crafted. And we're seeing attach rates which are now north of 50% on the digital audience that we are sort of bringing on the table. I think I think also we are looking at other products on the credit side which could be created for these customers. I think that also helps us increase the lifetime value, out of on the platform. So I think the first expansion would happen within the credit ecosystem itself. The next logical extension is obviously to think about other financial products, because a lot of the customers who we cater to on the credit side are obviously consuming other products as well. But we want to have a more data and an analytics-led approach to solving that rather than a distribution or a pure distribution-based approach. I think that's where the real value on the data lake that we have created starts coming through. And a lot of these solutions are getting worked on by our data teams in terms of building propensities, building customer behavior models, understanding what kind of products do our consumers consume. And that we are trying to build that graph of customers so that we can potentially profile a customers on potentially on a particular axis, and then thinking of the various products that the customers could consume on the other axis, and then over a period of time look at opportunities which are large enough and sort of adjacent enough where we could potentially foray to. So I think to answer his question, yes, there would be adjacencies that we would look at. There would be new lines of diversification that we would look at. But I think in terms of the operating model to completely play out on those products, it will probably a 3 to 5 year horizon is the right time to kind of look at that.
Thank you, sir. So the next question from Omkar and Hinglet was that can we compare Finbud with Paisabazaar on various operational metrics? And how different is the business model from Policybazaar?
So I think, Paisabazaar is a pure digital sort of a distribution platform. We are a phygital distribution platform. So we today have the ability of straddling both the physical ecosystem and the digital ecosystem, right? I think the first differentiating factor is really on the cost of acquisition, right? So pure vanilla first loan customer acquisition costs on digital loans tend to be very expensive. And hence, Paisabazaar for the longest time has had a sort of a cash burn model where they have spent monies on acquiring customers via platforms like Google and Meta to get high quality customers coming onto the platform, right? And that tends to be a sort of a burn model. And that's why pure digital aggregators tend to burn a lot of cash to acquire a customer base. Now, we have kind of differentiated ourselves by using a sort of a physical network to build the same quality of customer base, if not better, because it comes via a pre-screening route via the agent. But today we have over 45 million customers sitting on the data lake where we have all these pieces of information which any other digital aggregator has access to. So I think from that perspective, we've been able to build a competing model with the fraction of spends that some of the digital players have been able to do. So I think that's the first point that I would want to make. Secondly, in terms of the DNA as well, I think it's very difficult to, for an organization to straddle a physical distribution-led DNA and combine that with the scale and sort of approach that you need to build a digital business, right? And I think that's where a lot of the players have kind of tried but have not been able to succeed. I think even if you look at the narrative that Paisabazaar had, I think over the years, they have also kind of spoken about foraying into the offline world because that's very, very large. And if you have to kind of think about how the sort of the customers operate or where the banks operate, right? I think there's a significant amount of customers who still are choosing like physical channels or agent channels to kind of get serviced on, right? So I think this kind of a hybrid approach is where the differentiation really comes in. And I'm honestly speaking, to be able to execute a sort of a business strategy which straddles the complexities of building physical distribution along with being able to build capabilities on the technology, data, or marketing side are fairly complex. And I think we are kind of being able to successfully execute that. And I think that's where the differentiation comes in. And for us, the agent business is essentially a feeder business, right? So as it keeps feeding into the data lake, the opportunities then to monetize keeps increasing. And that's where the sort of the symbiotic nature or the flywheel that I was talking about really comes into play. So I think that's where the differentiation is. So in terms of line of business, of course, Paisabazaar and Finbud are in the same line of business, which is distributing credit products. But the approach to building the business is very different.
Right. Thank you, sir. Rahul, you can ask your question.
Yeah, thank you for giving me a chance again. Just, as you grow, let's say 35 to 40% over the next 4 to 5 years, does the composition of your lead, or, as you mentioned right now in the presentation, the top five lenders account for 70%. Does that composition change dramatically, or broadly you're going to take away, those guys are not going to grow at that rate, definitely. So, but are you going to take enough market share from within their scheme of things to keep their contribution like this, or this is kind of going to change?
Rahul, so I think the lender pool would largely be dictated by the market, right? So I think, and I think I would want to make a case in point of HDFC Bank here, right? So I think for the longest time, HDFC had only a physical model with us, and we were sort of operating via the physical network with HDFC Bank. I think last 18 months, HDFC has started focusing a lot more on their own digital business, right? And essentially opening the digital channels out. And I think we have gone and partnered with HDFC, and I think it's become one of the largest players with HDFC Bank over the last 18 odd months in their digital ecosystem as well. So I think where we see this opportunity is evolve is I think also there's a significant amount of digitization that is also happening in the traditional lending ecosystem, right? And today, if you honestly ask me, most of these lenders are running a dual model. So whether it's an HDFC Bank, whether it's a Bajaj, whether it's an Aditya Birla Capital, whether it's a Tata Capital, whether it's an L&T Finance, all these large names, we have a partnership both on the physical front as well as on the digital front, right? So I think that's where we are seeing a lot of the market sort of move. And within their organizations also, I think they have like competing challenger models that are getting built. And we, given the hybrid nature of our distribution, have then the unique position of being able to participate with lenders like these across both these forms of distribution. So I think I would think the lender pool would remain largely a reflection of the market share that some of these lenders have. But I think the differentiation that we have is the ability to kind of straddle the different channels that the banks are operating on. Also, I think from a relationship perspective, Rahul, the relationship only becomes stronger, right? Because if I have the ability of serving HDFC Bank both on the physical front as well as the digital front, now my ability to kind of become important for HDFC Bank also keeps increasing because now I'm no longer a monoline sort of a partner with them. I'm a sort of a multifold partner with them. So I think that's also some thoughts in terms of the question that you had in your sort of mind.
Right. And just some more understanding here. You have a database of, let's say, 4.5 crore customers with you right now. Bajaj Finance talks about, let's say, a customer base of 11 crore customers. Last week, kind of update, I got an update from them. Broadly, is there a broad overlap between these two numbers? And should we look at, let's say, 10, 11 crores is your possible customer profile as well?
So I think let me just put this number in context of bureau data, Rahul. I think is the best way of sort of understanding the market, right? So there are 40 crore people on the bureau, right? If I was to remove people who are on the agri side or maybe in terms of microfinance loans, etc., I think where Finbud honestly is, I think even in the future may not be a participant. right? That number shrinks to around 25 odd crores, right? So I think in terms of income generating population, which is there on the credit bureau, which is essentially a customer having at least one financial product, right? Because I think today we are not a platform which is looking at solving the new to credit customers or students who are looking at borrowing credit, etc. We are going after a customer set which is already on the bureau, which already has financial products, which understands what it takes to build a credit profile, etc. So 25 odd crore people is on the credit bureau, right? So that's the total size, right? Of course, there are segments which Bajaj may be operating in. There will be segments that even Bajaj may not be operating in, right? So I think hence their number would be 11 crores. Potentially that could go up further. I think there would be an overlap or a significant overlap between the business that we operate and the numbers that Bajaj is talking about. I think another point I would want to make, Rahul, is that we are, I think, more or rather over-indexed on the salaried population, right? I think some of the other lenders are obviously a more larger distribution between salaried and self-employed borrowers. I think given the nature of products that we are working on and the platform that we have created, I think we have more salaried borrowers on the platform than self-employed customers. So I think to that extent, the overlap on the salaried population will be very large. But I think we are all kind of playing in the same data pool.
And just one final question here. With your target of, let's say, 35,000 crore disbursement, what kind of numbers are we looking at on the master agent side? And does that go proportionately or, not so much?
It would go not exactly in proportion because obviously, the existing guys would also grow. But it would have to be more linear also. It will be linear along with the growth in our overall disbursal volumes.
Okay. That's about it. Thank you. Thank you so much for that. Thanks.
Thank you.
Thanks.
Thank you. Pratham, you can go ahead and ask your question.
Yeah, thank you so much for the opportunity. So my question is, what is our current monthly disbursal run rate?
So, as we said, we are targeting around 9,700 crores in this current financial year. So we are roughly in the 850 crore monthly disbursal now.
Yes, so if you could answer, what was the disbursal? What was the disbursal we did in the month of November? If you could answer that.
We are still in the process of, collating that data. The month end has just happened. So maybe in our next update, we'll be able to give that. But the 9,700 crore projection that we have given, that is assuming what we did in September and the gradual, organic growth that would happen. But we are fairly confident of achieving that number.
Okay, thank you. So my second question is, as we see credit growth is again beginning to pick up after bottoming out about 6 months ago, and now with RBI entering into a rate cutting cycle, both macro indicators seem supportive for our business. Given this improving environment, how do we see the growth trajectory for our disbursals going forward?
So over a long term, we have said that, we will be wanting to grow from whatever our current run rate to 1,000 odd crores. So on a long term basis, that's roughly a 35% CAGR that we see over the next 5 years. Obviously, in the initial years, that number will be higher than that and would probably tend to taper towards the end of that 5-year period, such that the average CAGR is roughly around 35%.
Yeah, thank you so much.
Thank you. So the next question we have in the chat is from Rohan. So he's asking that since bulk of our revenue comes from personal loans, can you highlight what has been the portfolio performance in terms of credit costs for lenders, NPAs in the portfolio originated by you for them? And he's asking that once disbursed, if the account turns NPA, do you play a role in the collections?
Yeah, so I think let me answer the second question first. We are an acquiring platform, right? We do not play any role in the underwriting of the loan, and hence we have no sort of obligation from a collection standpoint. So I think from a purely
one-time transaction,
it's a one-time transactional business. It's purely an acquiring platform. Our partnerships with banks and NBFCs is more on the acquiring side, and our role is limited to being able to bring in high quality borrowers for them. So I think that from a portfolio performance perspective, so while I think the point here is that, while there's not a direct economic bearing on the business model in terms of quality of portfolio, and hence this information is not shared by the lenders across the board for all the loans that we originate. But I think we also kind of keep doing these backtracking of these customers to understand how our portfolios are performing with some of the lenders, because I think that gives us, sort of a long-term goodwill with these guys. Unfortunately, it doesn't translate into any kind of an economic benefit. But I think I would want to make the case in point of HDFC Bank, I think, because they are our largest partners. And I think we have kind of seen that our portfolios perform significantly better than even HDFC Bank's own portfolio. So I think they sort of have a quarterly update that they share with us in terms of the customers that we have originated. And I think the last updates that we have received from them, our portfolios are actually doing better than even HDFC's own portfolio. I think one of the things that we continuously keep prodding or pushing our lending partners is to actually give us higher outcomes basis portfolio performance. But unfortunately, given the nature of business and given the fact that it's an acquiring platform, it's a one-time fee model. So while there is no upside in terms of portfolio quality, there is no downside in terms of sort of losses or collections, etc. as well.
Right, thank you, sir. So the question asked by Venkata and Hinglaj has already been covered. So I will skip to the question from Shamal. So he's asking that My Mudra operates with a business mix of approximately 15% digital and 85% physical, and records a PAT margin of around 10%. They also maintain a loan portfolio distribution similar to us, with a comparable personal loan to MSME loan ratio. Despite this, Finbud's PAT margins remain significantly lower. And could we analyze the key factors contributing to this profitability gap, given the similarity in the business model and the loan mix?
So honestly, this is a question which keeps coming back to us from various players. Our reply is that we do not have an insight on why on how they are showing such a higher margin. On a day-to-day business encountering perspective, we know that the margins which are currently for both them and for us, the overall margin profile is fairly dictated by the agent segment margins, because that accounts for 85% of both our businesses. On the agent business, the margins are very, very competitive. It is almost market determined, to the extent that over there, if there is a 5 to 10 paisa difference also, the agent tends to shift. So the margin profile that what we have is something that is completely market determined. Competitive natures are there in every market, whether it be tier 1, tier 2, or be it the metro. Hence, I would not know how they are able to show such high margins. That's a question that, honestly, I mean, because as we said that, and we have seen in the market that the 90% of the revenue that we share with My Mudra, we see their also payout sheets which are there floating in the market. So theirs are also similar, that they also tend to give 90% of their revenues, share 90% of their revenues with their agent. So in spite of that, how they are able to show that margin profile, we would be not able to comment on that.
Right, thank you. I think this was.
And I think one point just to add to what Parag was saying, that even if you look at the financial performance of very large platforms like Andromeda or My Money Mantra, right, who each of these guys have been around for over 2 decades, and you look at their financials which are available publicly through MCA information, right? In a best case scenario, their margin profile on the agent business is actually comparable, if not a little lower than ours. So I think I would just want to sort of add to that, because in terms of sheer and like Andromeda, I think from last year was around a 1,500 crore revenue company, right? So even at that scale, the margin profile is actually similar, if not a little lower than ours. So I think just that's
all the large players are in our vicinity.
Yeah, I think
obviously we should also appreciate that My Mudra is 1/3 our size. So at a lower base, maybe that is possible.
Right. Thank you so much, sir. So, okay, Omkar has just made a comment that request you to provide monthly performance updates to stock exchanges. Yeah, we will definitely make sure to do that, Omkar. So, thank you so much, everyone, for joining the maiden earnings call for Finbud. And thank you so much. Okay, Shamal has said thank you for the detailed clarification for our addressing our concerns. Your insights are truly appreciated, and we look forward to further improvements and continued collaboration. Thank you so much, Shamal, for the comment. And if you have any further questions, feel free to contact us at Go India Advisors. Or if you'd like a further meeting with the management of Finbud, we can get that arranged. But thank you so much, everyone, and the management. Thank you very much. And we will close the earnings call now. Thank you.